You've got $40,000 sitting in savings right now. It feels safe, it feels smart. But here's what nobody's telling you about that money. It's quietly losing value every single day you leave it there. And by the time you realize it, you've lost years of potential growth that you can't get back. My name is Alex, and I spend way too much time thinking about why smart people make terrible decisions with money sitting in their bank accounts. If you're someone who knows they should invest but keeps waiting for the right time or the safe moment, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you will completely change how you think about risk. Here's the thing about cash in 2026. Everyone talks about how risky the stock market is, how volatile things are, how uncertain everything feels right now. But nobody talks about the guaranteed loss you're taking by doing nothing. And I mean guaranteed. This isn't speculation. This is just math that actually happens to your money. Let's say you have $50,000 in a high-yield savings account right now. You're getting maybe 4.5% interest if you're lucky. You feel responsible. You feel like you're being careful. But here's what's actually happening to that money while you think you're playing it safe and being smart. Inflation in most developed economies has been running between 3 and 4% annually. Some years higher, some years lower, but the average is consistent over time. So your $50,000 earning 4.5%, you're actually gaining maybe 0.5 to 1.5% in real purchasing power annually. That means after 10 years, accounting for inflation, your $50,000 becomes roughly $52,000 to $58,000 in actual buying power. You've nearly doubled your actual wealth, not just numbers. The difference? $40,000 to $45,000 in real wealth. That's the opportunity cost of feeling safe. That's what not risking it actually costs you in reality. Now you might be thinking, but Alex, what if the market crashes right after I invest? What if I lose everything by making the wrong move? Look, I get it. The fear is real. The headlines are scary. Every financial news site makes it sound like disaster is always around the corner right now. But here's what most people don't realize about that fear. You're comparing a hypothetical future loss against a guaranteed present loss. That's not rational thinking. That's anxiety making decisions. Let me put it this way. Would you rather have a 10% chance of losing 20% or a 100% chance of losing 2%? Because that's actually the choice you're making when you hold excess cash instead of investing it properly. You're choosing the guaranteed slow loss over the possible fast one. And here's where the psychology gets really interesting. People feel the pain of losing money way more intensely than the pleasure of gaining it, about 2 times more intensely. So a $5,000 market drop feels emotionally like losing $10,000. But inflation eroding $5,000, you barely notice it happening in real time to you. That's why cash feels safe even when it's not. The loss is invisible. It's silent. There's no red numbers on the screen making you panic about it. Let's talk about currency risk for a second, because this is something that blindsides people. Your dollars aren't just losing value to inflation within your own economy right now. They're potentially losing value relative to other currencies and assets globally. If your currency weakens, your purchasing power for international goods drops, even if domestic inflation seems manageable. I'm talking about travel becoming more expensive, imported goods costing more, your relative wealth compared to people in other countries shrinking without you doing anything wrong at all. In 2020, one US dollar bought about 0.9 euros. By late 2024, that same dollar bought roughly 0.92 euros. Seems small, right? But that's a swing. Now imagine you're holding $100,000 through currency fluctuations over 10 years. Even a 10% currency devaluation means your international buying power drops by $10,000 effectively.
This isn't fear-mongering, this is just the reality of holding cash in a global economy where currency values fluctuate based on policy, trade, and economic conditions beyond control. So here's what people who understand this are actually doing in 2026. They're not going all in, they're not gambling, they're building systems that work regardless of certainty. First thing they're doing is staged entries into the market. Instead of dropping $50,000 in one lump sum, they're dollar cost averaging over 6 to 12 months. This means investing $4,000 per month if you got $50,000 total. You're buying at different price points, reducing timing risk, making it less stressful emotionally too. Second, they're diversifying across asset classes properly, not just stocks. They're looking at stock index funds, bond ETFs, real estate exposure through REITs, maybe some commodity exposure too. A typical allocation might look like 60% stock ETFs tracking major indices, 25% bond funds for stability, 10% REITs for real asset exposure, 5% cash buffer. This isn't sexy, it's not exciting, but it's what actually works when you don't know what the market will do next and you need to protect yourself. Here's what nobody tells you about waiting to invest until things feel safer. Every year you wait is exponentially more expensive than you think it is right now. It's not just 1 year of missed returns, it's 1 year of compounding that you can never get back. That's the part that kills long-term wealth building slowly. Let me show you the math on this because it's absolutely wild. If you invest $10,000 today at 7% real returns, in 30 years, that's $76,000. If you wait 5 years and then invest that same $10,000, in the remaining 25 years at 7%, you only get $54,000 total. You waited 5 years. You lost $22,000 in final value. That 5-year delay cost you more than double your initial investment amount over the long run here. And this is assuming you actually invest after 5 years. Most people who wait just keep waiting. The right time never comes. The money just slowly evaporates through inflation instead. Now, you might be thinking, okay, Alex, but what if I invest and the market immediately drops 30%? How is that better than cash sitting safely?
Fair question. Let's talk about downside protection, because this is where strategy matters more than people realize. You don't have to choose between all in or all out completely. The strategy that makes sense for most people is keeping 3 to 6 months of expenses in cash for emergencies. That's your safety buffer. That's your sleep well at night money. Everything beyond that, that's money that should be working for you. And even within invested money, you're using bond allocations to cushion the volatility from stocks dropping suddenly. So if you've got $100,000 total, maybe $15,000 stays in high-yield savings for emergencies. $85,000 gets invested with proper diversification across assets and time. If the market drops 25%, your stock allocation takes the hit, but your bonds typically hold steady or even gain value. Your total portfolio might drop 15% instead. Yes, you're down temporarily, but you're still earning dividends. You're still positioned for the recovery, and you're still way ahead of the inflation eroding your cash over the same period. Let me give you the actual step-by-step that people are using right now. This isn't theoretical. This is the practical implementation that works in reality today. Step 1. Calculate your true emergency fund need. 3 months minimum expenses if you have stable income. 6 months if your income is variable or uncertain in any way. Step 2. Everything above that amount is investable capital. That's the money that should be working for you instead of sitting idle, losing value to inflation and opportunity cost daily. Step 3. Choose low-cost index funds or ETFs that track major markets, something like VTI for total U.S. stock market, VXUS for international, BND for bonds exposure. Step 4. Set up automatic monthly investments. If you've got $60,000 to invest,
That's $5,000 per month for 12 months. Set it and forget it. Seriously. Step 5. Rebalance annually. If your stock allocation grows from 60% to 70% of your portfolio, sell some stocks and buy bonds to get back to target. This is boring, this is unsexy, but this is exactly what actually builds wealth when you can't predict the future and need systems that work regardless of market conditions. Here's the psychological shift that successful investors make in their thinking. They stop seeing investing as gambling and start seeing cash as the actual risk they need to manage. They understand that doing nothing is itself a decision, and it's often the worst decision, because at least with investing, you have a chance at growing your purchasing power long term. With cash, you have a guarantee of losing purchasing power. The only question is how fast. That's not safety, that's just slow wealth destruction that feels comfortable because it's familiar. Think about it this way. If someone told you they had an investment that guaranteed you would lose 2 to 3% annually forever, you'd think they were insane. But that's exactly what holding excess cash is. It's that investment. You just don't see it as clearly because there's no negative sign on your bank statement showing the loss. The real risk in 2026 isn't market volatility, it's not recession, it's not uncertainty. The real risk is arriving at retirement and realizing you had the money all along. You just kept it in the wrong place. And now you're 10 years behind where you should be, with no way to get those years of compounding back ever again. So here's what I want you to do after watching this video. Not tomorrow, not next week, not when things feel safer or more certain or more comfortable for you. Today, calculate how much you have in cash beyond your emergency fund. That number is your opportunity. That's money that should be working for you right now instead of against you. Open a brokerage account if you don't have one already. Fidelity, Vanguard, Schwab, any of them work fine. This takes maybe 15 minutes. There's no excuse for not doing this. Choose a simple 3-fund portfolio or a target date fund that matches your retirement timeline. Start with your first investment today, even if it's just $1,000 to begin. Set up automatic monthly investments for the rest. Make it systematic, make it automatic. Remove emotion from the equation entirely. That's how wealth actually gets built in real life. And remember this, in 10 years, you'll wish you had started today. The best time to invest was 10 years ago. The second best time is right now. Stop letting fear disguise itself as caution. Stop letting inaction disguise itself as safety. Your future self is counting on the decisions you make today. Don't let them down by standing still. If this video shifted your perspective on investing versus holding cash, hit that like button and subscribe for more real talk about building wealth in the modern economy. And drop a comment telling me how much you have sitting in cash right now. Let's hold each other accountable. Let's actually do this. Your financial future starts today.